Now, is there going to be a crash coming in not just the real estate market, but economies and the world markets in general? Well, possibly. And that's something I want to talk to you about today. Now, I have seen a big crash back in 2008. Many people lived through it, but I was actually investing through the crash in 2007. 2008, I started buying properties in 2006. Right as it was running up, I started thinking, hey, it's a good time to buy real estate. Well, in fact, it actually was a good time to buy real estate if you bought it right. And I'll tell you exactly how to buy it right later on in this video. But what I want to talk to you about is the actual crash or correction. I like to say correction because I'm not going to say it's a crash, but coming soon, there's going to be some sort of correction. If it's a crash, it'll be dependent on a lot of different variables, but we're going to talk about all that right now. Hey guys, Dustin Heiner here with Master Passive Income, and I'm here to help you learn how to quit that JOB, that just over broke job, by investing in real estate rental property so you never, ever have to work a job again. And don't forget to subscribe to my channel because I'm constantly giving out great information on how to invest in real estate. So subscribe and also click that notification bell. Let's get into it. Now, as we are looking at potential crash or correction in the real estate market or the markets in general, like the economies in general, there's so many different factors. Now, I remember back in 2006, 2007, when I first started investing in real estate, I was living in California, literally living in California and then investing in Ohio and Texas and Arizona because California was really expensive. Everybody knew that was so crazy a time when the market just kept going up and up and up. Now, I was buying for cash flow properties, not for appreciation. We'll get into all that and how to actually invest right now, even if there's a crash coming. I'll show you how to do that as well. And I started investing in 2006. And as I was investing, I was buying cash flow properties that made me $250 or more in passive income from the rents. But once it got to 2009, then the crash happened. So the prices kept going up, 2007, 2008, 2009, and big crash. Prices of the homes dropped dramatically. And we're seeing that literally right now. In fact, it's almost even worse. Now, I'm not going to say that there's going to be a necessarily like a big crash where it was like in 2007, 2009, but there will be a correction. Now, there are so many things I want to talk to you about. And the first one is when we're investing in real estate, if we invest for cash flow, where money comes into our pockets every single month from the rents minus the expenses, if we invest for $250 a month in passive income, no matter what happens, if the market goes up, if the market goes down, or if the market goes sideways, we still make money because we are investors in cash flow. If we invested just for appreciation, if we were flipping properties, we would be losing money because we would buy a property here, we'd think it'd go up to here, but then crashes down to here, we lose money. We don't want to do that, so we invest for cash flow. So in 2009, I was buying properties for cash flow, making money. And even when everybody was losing their shirts, like everything was going bad, people were going bankruptcy, all these things were going really bad, I did fine. In fact, that's how I quit my job, was investing in real estate rental properties, and I make $250 a month from every single property. I have 30 plus properties now, so I have plenty of money coming in. Now, what I learned back in 2006 and 2007 and up into 2009 was that there will eventually be a crash. Now, I'm going to tell you something that happened recently. So in March of 2020, obviously COVID-19 happened. Everybody was calling for, oh, this is the crash. This is the crash. And I said, no, it's not. This is like manufactured crash. In fact, the reason why is all the businesses shut down. They stopped. Now, what you're going to see is people are going to come back to work, which they have now. They've come back to work and they are back to work. But let's see future down the line. What could happen in the future? Now the economy is coming right back. In fact, before it was artificially closed down because of the COVID-19 and everything closing down. Because of that, it was artificially brought down because no business. Everybody stayed at home. But now it's coming right back up. So you don't see a crash right now. Like literally right now, it's literally not a crash. This is what, September, October of 2020. Well, I'm seeing a correction that should come. Now, there are 4 different reasons why I see somewhat of a correction or possibly a crash coming somewhat in the near future. I'm not going to give you a time frame again, but just be watching for these. Now, the first one is interest rates. Second one would be home prices. Number 3 would be supply and demand. And the last one would be unemployment or jobless rates. All of these are interconnected and affect what's going to happen in the market as well as the greater economy. Now, let's look at interest rates alone. Interest rates are very interesting because there's a number of different factors that go into this. Now, back in, I think it was like January-ish, the Federal Reserve lowered their interest rate down to zero, like literally zero. Now, that is just borrowing between banks. It's not a mortgage rate. But what I said back then in January, and what's really interesting, the mortgage rates were probably about 5 or 6%, maybe 5.5%, 4.5% to 5% back in January for mortgage rates. And the Fed just cut it to almost zero, or basically zero, for interest rates between banks. And I called and I said, you know what? Watch for mortgage rates to follow. Mortgage rates always follow interest rates from the Federal Reserve. So next 3 or 4 months, watch for a really, really good interest rate on your mortgage. And this is exactly what happened. On top of the COVID-19, there was another thing that actually just threw all this stuff out. That was more of a black swan event, just basically something that just happens once a lifetime. Like, it probably will never happen again. I hope it doesn't happen again. But what we're looking at, prices now, interest rates for homes are as low as like 2.75. I was talking to somebody that was literally buying a house to live in. They got like 2.5% or 2.75%. That is ridiculous. I'll tell you something I'm doing because I see such great interest rates being so low right now. I am literally refinancing one of my investment properties. It's not a personal house. It's not a second home. It is classified as an investment property. And the banks, what they're actually doing is they're going to give me a 3.125%. I think I had to pay like $700 to get the rate down just a little bit. But shoot, it was 3.1%. That is so cheap. And I'm going from a 30-year down to a 20-year note. On top of that, what I'm also doing is I think I'm only paying like $20 more. So I'm less in total time, less interest, less all around. So you should be doing that too. But what's interesting, when interest rates go lower, that means prices go up. Here's the reason why. Everybody only has a certain amount of money to spend either on rent or on a mortgage payment every single month. Let's say that Joe Smith only has $1,500 a month to either pay for rent or pay for a mortgage. Well, if the interest rates are like 5.5%, 6%, the amount of money that he can borrow is much lower than when it is like 2.5%. Because when you have a now let's go up a little higher. When you have a $200,000 house, if you borrow $200,000 at 6% or even 5%, your mortgage payment is going to be closer to like $1,600 to $1,700 a month. Now, if you also had that same $200,000 loan, but you're paying 2.75, your mortgage payment is going to be like $1,100, maybe even $1,000 or less. It's going to be so much lower. So they're going to say is, man, I still have $1,500. It's only going to be $1,100. Let me find a higher house or a bigger house and a better house or more expensive. So it goes up and then this goes up, and then it goes up because they have more money. Well, it's the same money every single month, the same $1,500. But what's interesting is that money goes so much further. So that's what happens to home prices. Now, with interest rates all being covered, let's go to number 2. Your home prices. Right now, literally right now, prices are skyrocketing. I mean, it's going up so high, and it is so amazing to see. Now, in a bad way, Phoenix, right now, where I currently live in Phoenix, there's a city called Surprise. Surprise isn't the biggest city, and it's not the most well-developed city and all that sort of stuff, but houses are selling for $500,000. There's no reason, this is not Scottsdale, this is not Hollywood or whatever. I know Hollywood's a lot more, but $500,000 for a house is ridiculous. And the reason why is the same thing with the interest rates. People still have $1,500, $1,800, $2,000 to buy a house. It keeps the prices going up. So as I see prices, in 2006, it was really going up. 2007, 2008, 2009, and then it crashed. And then it came down. Now, literally 12 years later from then, it's right back up to where it crashed. So it went up here, crashed down here. Then it's right back up to where it crashed. And then now it's above that even. It's like 20% above the prices of when it crashed. And in my opinion, in 10 years or 12 years, it should not be above where it was when it crashed. If it was bad when it crashed, there's no reason why it should be like that this high right now. So I'm seeing prices being so crazy high. Now, I will give you a caveat because I'm an investor. What I want to do is I want to show you how to be prepared for the future, for this correction or this crash, so you can capitalize on it. So watching a little bit in the end of the video, I'm actually going to give you how to actually prepare and be ready for this great opportunity to be buying loads and loads of property. It's going to be like a $300,000 house. It's going to be on sale for like $130,000. You're like, yes, please. Yes, please. In fact, I have lots of money just sitting on the sidelines in a money market account making me, I don't know, 2 or 3% right now, which is really good. But I'd rather have it in a property, but prices are so high right now, so I'm not. Now, next up is supply and demand. With COVID-19, that was a whole nother ball wax of things going on with demand and supply. The demand died down a little bit because people were locked down, but the ones that would normally buy, they prolonged when they would actually buy because they just waited to see what's going to happen. Then also that accumulated more people that wanted to buy. Interest rates down, that's more people that wanted to buy, but the demand was high, and the supply was very low. Because of COVID-19, supply was so low because people weren't listing their properties. They think, man, why would I list my properties? Nobody's buying right now. Why would I do that? Well, what's interesting now, once COVID-19 started to get a little more on the back end, where people started realizing, I can get out of the house, they started listing their properties. And those properties are listed for sale. But there's so many more people. It's regular just supply and demand. Supply and demand. If there's high demand and low supply, that means the prices are going to go up, just like everything else. If you're going to buy, we saw the toilet paper was literally gone. They were selling toilet paper on eBay for like $1,000. Crazy, because there's a lot of demand, very, very low supply. Same thing with houses. Now you have a lot of demand for people who have more money to spend. They're realizing I got to move out of the big cities where there's a bunch of rioting and looting and all that sort of stuff. They want to get out of there. So many other reasons, but that does not change the amount of supply. Supply is still low because people are thinking, I better just wait. I better just hunker down until all this COVID-19 stuff goes away, and then I will be able to actually live my life like I want to. Wait till all the rioting and looting and the stealing all stops, then I can make a move, which is supply and demand. So very high demand, very low supply, which makes prices even higher than it should be. Next up, the last one is unemployment rates or jobless rates. Now, we know with COVID-19, we had record unemployment, like record everything, like literally 2.8% unemployment of the entire population. That is never heard of. That is so brilliant. Then COVID-19 happened. Then it dropped to like 20% unemployment. It's horrible. Everybody's, they're on furlough or they're losing their jobs. Really, really sad. Now, the economy's coming back. Now, what's interesting is you're going to have probably heard many, many people back in March with COVID-19, everybody screaming, this is the crash, this is the crash. I wasn't doing that. And the reason why is because it's an artificial, like I said, Black Swan event. It's an artificial change in the market. As soon as people get back to work, it's going to pick it right back up. Now, the thing though, even though jobs are coming back, there's a downside right now. A lot of small businesses are closing down because all the money went to Walmart, to Amazon, to Facebook, to all these big, Apple, all these big companies made, and hopefully you're not going to get too mad, but they made so much money. Hopefully you're not getting mad at them, but they're doing their business. But what was sad was I saw even just home delivery people, they were getting arrested for driving around when Amazon could drive around and deliver things. So what's really, really sad is all the money went to these big companies. Now, what's interesting is these small mom and pops, these small people that just want to make a living and provide for their families, they don't have their businesses anymore and they don't provide jobs anymore. That is really, really sad. Until that picks up, I don't know how much more unemployment's actually going to be going down anymore. It might stay up because the businesses are gone. Not everybody's going to be able to work at Amazon or Apple or something like that, or even Walmart, for instance. Now, when you sum all of that up, what you see is really low interest rates. But interest rates have to go up. They will always eventually go up. It goes up and down, but it will go up. I know back in 1990s, my parents bought their house. They paid like a 17% interest. That is, think of mind blown. What if it gets back up there? That means prices are going to crash. Not saying it's going to do that, but if it does, oh my goodness, even if it goes from 3% to 6%, 7, 8, 9%, that is so much less money. Somebody only has $1,500 to spend in rent. So what's going to happen is that $1,500 goes so much less far. And so it goes down, 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 down. And on top of that, prices are so high. Eventually, people are going to say, you know what? I just can't afford this. And what happened in 2007, 8, and 9, when the crash happened, people walked away from their houses. So people who are buying $500,000 houses in Phoenix right now, which is silly to me, they're going to say, you know what? My house is worth $100,000 less than when I bought it. $200,000 or $300,000 less than when I bought it. I'm just going to walk away. That's going to exacerbate or make everything worse. It's going to make it so much worse, just like in 2009, where everybody kept walking away from houses. But what's great for us, and I'll give you just a second, how we will be able to invest and capitalize on this because we're investors. See, now the big key I'm going to give you is when people are selling, we need to be buying. When people are buying, we need to be selling. That's the bottom line. You absolutely need to do that. Now, what we're looking at now is prices are just jacking up really, really high. We're looking at potentially coming bubble. If you look at the way that the economy was back in 2008, 2009, when it crashed, it was going up really, really high, and there was a bubble and it burst and it popped and came all the way down. It was dramatically lowered. Same thing. What is really, really interesting is now, 12 years later, remember the crash was like 2008. This is 2020. This is 12 years later. Now, every single market cycle is usually about 7 to 8 years. That means market goes up and corrects and comes down. Goes up and corrects and comes down every 7 to 8 years. But right now, what's happening, it has literally not corrected in 12 years. 12 years. Ever since like the history of that we've actually been recording, it's been up and down for 7 and 8 years. Now it's literally been 12 years of up and up and up. If you look at home prices, at the crash at 2009, they were this high. Right now, they are like at least 50% higher than where the crash actually was back in 2009. And in 10, 12 years, there's no reason for it to go here, then back down, and then back up even much more so, like 50% more than when it crashed back 10 years ago. Now, that is super scary, seeing that. Well, scary if you're not an investor. If you're an investor, I'm actually really excited, which we'll get into in just a minute. But what we're looking at is we have inventory, we have interest rates, but we also have jobless rates. Now, what's looking like right now is because of COVID-19, the jobless rates are really sky high. But at the same time, businesses are coming back to work, people are getting back to work. But at the same time, when there's a contraction in the market or in the economy, when there's a contraction, and there are elections coming up, and that is another huge thing that is really needs to be put on our radar, because the incumbent president, whoever it is, Republican, Democrat, or whatever, they always want the economy to be as good as possible. The one that's in there in office that wants to get reelected, they want to make sure that the economy is good because, hey, look at my track record. It looks really good. The one that's coming in wants to say, no, the economy's bad. Hire me or elect me and I will make the economy good. I'll make your lives better. Now, the sitting president will make sure as best as he can that interest rates stay low. So he's going to be pressuring the Federal Reserve, like whichever president, doesn't matter who it is, which side it is, they're always going to be pressuring the Federal Reserve to lower the interest rate so the economy stays high. The new one, the one that wants to come in, wants the economy to go low. So what's going to happen is the economy is going to stay high. And this will almost be 13 years of constant up. When it's been up and down for 7 or 8 years, every 7 to 8 years there's a contraction. Well, this is almost double that. This is 13 years of up. If you look at a graph or look at the chart, it's actually really so high. There's going to be a bubble. It's going to crash. Another thing is jobless rates. Now, jobs are coming back, but at the same time, it's projected that there are going to be like 20 million jobs lost in the next year or 2 years. With that, that's less money in the market. That's really concerning for us as investors. But at the same time, if there is a correction, us as investors will do very well. And I'll show you how to actually do that when you're investing. And now that we know that there's possibly a correction or a crash coming, what we want to do is be ready for when it happens and be ready to invest. Now, watch this video right here because I'm going to show you exactly how you can be ready and start preparing now for this future crash. So watch this video right here. I'll see you in the next one.